Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Friday, March the 20th, 2026. Almost in spring, which is happening tomorrow. Okay, guys, just have a couple of charts here, which I want to have a look at here. You see the problem here. This is the inflation swaps in the US, which was the snapshot actually is from yesterday, but it's pretty much similar to this morning, I would imagine. And you can see here that all the different tenors. So you've got the 1, 2, 3, 4, 5, 6, 7, 8, 9 out to a sort of 30 year. And basically, you can see that over the last sort of week or so, the inflation swaps have really ripped a lot higher. So the market is very much focused now on this whole sort of Iranian situation as it's been filtered through to inflation concerns and central bank reaction functions. And that's really the entire problem here. So we can talk about Ataco, so Trump sort of pulling back from the brink. But in my view, I just want to bring up here the oil price, or just as we're just going through a few things here. Let's just bring up the when I say oil, again, we have to be very careful and say this is American oil, WTA. But really, some commentators, there was quite a strong market reaction yesterday that Netanyahu came out in a press conference and said that finally, A, he wasn't pressuring the US was an independent actor, and that B, he said that Iranian missile sort of production capabilities and firing capabilities were very, very degraded, and that basically the war was going to be sort of ending relatively soon. And so the market loved that. We had the equities ripping. We had sort of gold even going up a little bit. We had oil coming down. We had the US dollar coming down, all the classic reactions, which we know now. But at the same time, and here's the problem, in the fog of war, at the same time, one of the senior Israeli military officials was saying that he thought they were about halfway through the campaign. So clearly no sense that the war was ending soon. So the whole problem for the market, and again, I'm doing this on Friday morning, and what we've seen is that especially the Trump administration seems to have a propensity to doing sort of significant military action over the weekend. I guess the logic here is that, the markets are closed, so to speak, and there'll be less damage done to the markets. But we have seen over the last 2 or 3 weekends substantial military escalation. And I think today, in general, we're seeing that the markets are trading a little bit heavy, a little bit risk off going into the weekend because everyone's a little bit sort of fearful that there could be some sort of literally sort of a bombshell, sort of metaphorical and also physical. But in terms of the reaction function, I mean, it's clear we all understand that Trump would prefer this war to somehow come to a speedy and victorious conclusion. But the problem is, if he does a unilateral taco, is that going to be enough? For sure, there'd be a short-term rally, but we're starting to have a case of the boy who cried wolf that clearly, a Secretary of Energy, Wright, comes out and says, oh, we're doing this to control the price of oil. And Treasury Secretary Bessent comes out on TV every sort of second day and says, oh, we're doing this and, et cetera, et cetera. And but on the other hand, if you listen to what the Secretary of War is saying, Hegseth, whatever his name is, Pete Hegseth, basically saying that, the war is going well, it's on track, it's ahead of schedule. But I don't really have a sense from him that the full objectives have been achieved. And the main objective, as far as I can see from the market wants to see flows of goods, so energy goods, oil, crude oil, refined products, helium, food, fertilizer. It wants to see the Strait of Hormuz open. And at this point, I can't see Iran suddenly, if America says, okay, we've had enough bombing, we're bored, Iran says, okay, no problem, let's just go back to where we were. I don't know that that's necessarily going to happen. So the market, as I say, wants to see those flows to resume, and therefore, obviously, that will be less inflationary pressure, or at least the perception of less inflationary pressure, and therefore the central banks can go back to that slightly more or less restrictive a sort of policy and the whole unwind. But having said that, everything I'm reading, we had comments yesterday from sort of Qatar. Everything I'm reading is essentially pointing to the facts that, for example, in Qatar, they're saying that about 17, 18% of their production has been sort of heavily damaged, and that to repair the damage may take 3 to 5 years. 3 to 5 years to repair some of that infrastructure. So the issue here, I think, is twofold. Is that for sure the markets would have a quick bounce on any sort of cessation in hostilities. But the problem here is that that is going to require Iran's cooperation and Israel's cooperation. And I think Israel has a lot more aggressive sort of an end game than, let's say, the US. And secondly, the ongoing effects of sort of shortages around the world, I don't think they're miraculously going to sort of end within 24 hours. And just as an example, as I just said, something like Qatar, they're talking about multi-year sort of a timeline to redo their infrastructure. So so let's look at oil here. And again, the key thing here is that this is WTI oil, and what we can see here is that yesterday it actually traded down. There was talk, there was like maybe the U.S. Besant was saying that maybe Iranian sanctions or sort of sanctions on Iranian oil, the oil which is sort of floating around on storage, maybe those sanctions may be lifted. So some of those Iranian barrels, which previously were sort of illegal or sanctioned, may be released into the market. That's possible. We've seen that the US administration has taken off sanctions temporarily, apparently, greatly ironic. I wonder if Zelensky loves this on Russian oil. We've also seen that, the potential for an export ban of US oil doesn't seem to be sort of happening. So definitely the US administration is looking around for ways to keep the oil price at home in the US down. And you can see that it's been relatively contained. Definitely we seem to be carving out here some kind of range between, let's call it $100 and 92. That seems to be the range. And yesterday we actually had a bit of a down day. But as you can see, the market is like a sort of a beach ball. It's sort of, you try and push it underwater, but it kind of pops up a little bit. And really the big question here is that if you look at over at Brent, you can see the price action is much different. And the actual differential, we're trading at $108 this morning in Brent compared to about 94 in WTI. So huge differential in Brent. And I was looking yesterday, you look at some of these other sort of grades, sort of the Saudi grades, the Dubai grade, Murban is another grade. These things are trading at much, much higher prices even than Brent. So really what we're seeing is that in the US, the WTI price is being relatively contained in a very relative sense, but other grades of global oil are much, much more expensive. And then probably even a bigger product, it's the refined products, not so much the crude oil, which have skyrocketed and doubled in price. So you have things like jet fuel, you have things like diesel, and other sort of refined products, which are like double the price. And now a lot of countries which sort of refine it, for example, South Korea doesn't really produce crude oil, but it's a huge refiner. Same as China, I think Thailand as well. Some of these oil refining countries are actually restricting their exports of refined products, and that's starting to create some real shortages of refined products with jet fuel, cooking oil, heating oil, diesel, which is obviously used for transport, especially in Asia, but increasingly so across the globe, because obviously if you have Asian markets scrambling for a lot of these refined products, that's going to cause more competition and therefore higher product prices globally. So we're all interconnected. So the point is that I don't think suddenly, even if Trump, this afternoon or on, Sunday night says, oh, by the way, I'm bored, I've had enough, we're going to stop bombing. My point is that these supply chain disruptions for sure will start to ease, but we're going to have a multi-week at minimum unwind. So therefore, I think energy prices will remain elevated in the short term. And I think therefore, in terms of bonds and whatnot and equities, we've seen a huge run up in sort of 2-year yields as central banks. We had all of the central banks this week, and we've seen it from the ECB, from the Bank of England, from the Fed, from Australia, the Bank of Canada. Everyone is every sort of central bank is very, very concerned. And not necessarily hiking, but certainly not in a cutting mode with these elevated levels. And if you just look, for example, here, look at the German 2-year yield, the 2-year bonds, you can see here completely sort of even today down more. So this is forcing sort of front end yields to rip higher, all yields, but especially the front end. If you look at the ZT, so the 2-year sort of futures in the US, you can see after Powell on Wednesday that collapsed. But what's disturbing is that, it had a little bounce back yesterday, but in the overnight session going down even more. So at the front of the curve, we're getting this huge ramp up in front end yields, also in the back end, but especially at the front end, causing the curve to flatten. And we've also seen that in sort of the British short-term bonds, the Canadian short-term bonds. And so as long as we get that, we're going to continue to have sort of pressure on equities. And the other interesting thing as well is that just overnight, sort of the risk off, if we start looking at some of these sort of charts here, you see VIX still, it's come in a little bit, but it's just basically stuck now at elevated levels. By the way, we have a huge option expiry today, so there could be some volatility. There's been some gamma pinning, and once that's unpinned, we might have a little bit more volatility starting off next week. But the point is that the VIX here is still at 25, so still very, very sort of elevated. And if we go to the equity market, you can see here just overnight, we had a little bit of a little sort of a pump and dump yesterday on Netanyahu's Israeli prime minister's comments saying, hey, the war is going pretty well. Maybe it's not going to last that much longer. But the market, basically has given that back because there was a report from Axios overnight, essentially saying that the Trump administration is mulling essentially sort of a ground invasion. Well, you could call it a limited ground invasion, trying to overtake the Karg Island and a couple of the other islands just near the Strait of Hormuz, basically to put troops on the ground. So it wouldn't be a full invasion of Iran. It would just be a strategic sort of holding of some of these key choke points. But that's going to get very, very messy because one would have to assume that Iran is going to respond very, very forcefully to that. And the other issue there is that the physical troops, the Marines, apparently they're about 1 week away. They're sailing from East Asia. So my point being that I don't see any rapid de-escalation of this situation, even if Trump wants it over the next 3 or 4 days. And as I said, it is a Friday. And we're seeing some risk off just on these reports of a potential sort of escalation and ground presence of U.S. troops in parts of Iran. So we're seeing just here the ES down overnight pretty heavily. It's breaking this key level, which is a double bottom now, a triple bottom at 66.30. That seems to be the key level. As you can obviously see, it's broken the 200-day. So at this point, I mean, I don't know what to say. This is very, very heavy price action. Any little sort of rally is being hit, and that's it. This is a situation to be shorting rallies rather than being the hero here. Now, is this a good buying opportunity? Yeah, for sure, if the war comes to an end. But as I say, judging by yesterday's pump and then subsequent dump of the Netanyahu sort of comments, the market is anxious for good news, but wants to see like a real follow through. Similar situation here for Nasdaq. Below the 200-day moving average, almost, breaking through its lows here around about, let's call it about 24,500. Again, trading very, very heavy. There was some specific news this morning about Micron's, some of their partners being sort of investigated for potentially illegally sort of exporting NVIDIA chips. We'll see where that goes. So the equity is trading very heavy. If you look across at Europe as well, if we look at global equity here, if we look at, let's say, the Euro Stoxx 600, also trading around the 200-day moving average, pretty key level here on the Euro Stoxx at 574. So very, very heavy. Similar kind of situation here with the DAX, just really not doing well. If we look over the Nikkei, also having a down day. So global equity not doing very well. If I look across at China, a similar red candle. So you get the picture. Global equity also not doing well at all. And we've talked about the bonds again. So we have a situation now where bond yields are up. We have a strong US dollar, which it gave back a little bit yesterday. But as I say, we've got the Brent oil up. We've got European gas remains extremely elevated. We also have gasoline here. Look at gasoline in the US, the RBOB contract, New York contract at highs. So compare that to oil. It's excuse me, it hasn't even retraced that much at all. So gasoline price is very elevated. So a lot of sour sentiment. Yesterday we had a bit of a risk on. We saw the US dollar coming back, but you can see just as we go into Friday here, sort of the nerves are coming in. So US dollar regaining a bit of strength, and you see that just a stabilization in the euro, Aussie dollar down a little bit. So the currencies are stabilizing, but the market is in no mood to really sort of rally. And as I say, we're going to have to see significant and actual concrete progress in reopening the flows of the Strait of Hormuz. We also see in the precious metals, gold had a horrible 2 or 3 days. There's also been some talk, apart from the fact that real yields are going up. So as real yields go up, that makes gold less attractive. We had a pretty strong US dollar sort of overall for the last, sort of 4, 5, 6 days or so. So gold under a lot of pressure here. Had a little bit of a bounce this morning, but definitely sort of under pressure. Silver bouncing here. That's probably what gold had the bounce as well. So silver bouncing off that key level. But there's been some talk, getting back to gold, that a lot of countries which are being hit sort of economically, especially, let's say, in the Gulf, so countries which we could call surplus economies, which had been sort of diversifying and putting some of their sort of extra cash, so to speak, in gold, maybe liquidating a bit of gold. Because the point about gold is that it's a great hedge, but it's also a wonderfully liquid asset, which in times of stress, if your sort of oil exports or energy, or in the case of Qatar, LNG exports have been sort of a hit. Maybe you want to sort of liquidate a few $100 million, a few $1 billion in gold quickly. and even treasuries, and we've seen the treasury yields ripping higher and the price going lower. So I think here that gold, once it's stabilized, I mean, I'm thinking that something, around about this 4,400 level here is quite an attractive level because I personally think that the macro factors are still in favor to be sort of long gold. But we want to see these liquidations finish off. We can also see with the risk off today, you see copper had a little bit of a bounce yesterday off this 200-day moving average, but copper also trading heavy this morning just on the risk off and sort of the fears to global slowdown. And then our dear old friend BTC, not doing much. Basically, as I said, failed at this sort of first hurdles, failed three times now. So again, very, very poor price action. So that's about it. As I say today, I personally think it's a day to be selling any sort of rallies on the equities. There's going to be some option expiry sort of volatility. We have AM and PM expiries. So as I say, we need to be listening for sort of geopolitical headlines. I have no doubt at all that the Trump administration will be sort of on the on the various channels on Twitter, on whatever, essentially trying to talk down the price of US oil, and they're doing a reasonable job of that. But as I say, the problem is that globally, other grades of oil are still very, very expensive and refined products, and that's going to continue to keep global energy prices elevated. So let's keep an eye on all the headlines. And as we go into the weekend, I expect to see oil relatively supported, equities weak, gold probably pretty flat, and the US dollar relatively supported. As I say, absent any kind of sort of major sort of announcement, which, as I say, would have to be validated in a sense by the Iranians and the Israelis as well, apart from the Trump administration. Okay, guys, thanks for that. Have a great day and have a great weekend. Take care. Thank you.